Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. If you take a look around what's been going on for the last couple of weeks, well, you can imagine what tonight's topic about. Basically, how to protect your money, how to grow your money when the politicians are, let me be polite, behaving badly. Well, Warren, good evening. I mean, you've chosen a good topic. It's been just the last few weeks have just been utterly insane.
They have, and it's almost, irrespective of what country you look at, we see politicians seemingly doing their best to act against our interests as citizens and as investors rather than for our interests. And you're right, Stephen. I think it's caused enormous ructions right around the world, and people are worried from a valuation perspective. People are worried about the value of their investments, and they're worried about whether they'll be able to retire, or if they are retired, will their retirement money recover? And then business people are phenomenally concerned about whether they'll be able to sell goods. Will they be able to get stock? Will they be able to pay a reasonable price for that stock? And will they be able to sell their stock to their clients at a fair price? And so we're it would be an exaggeration to say we're at peak uncertainty, but we can't be far away from it.
Do we need to sort of prepare ourselves for a bit more? I mean, my sense of things, both here and abroad, is that we're not quite through it yet. In fact, I think the South Africa situation is easier to predict than what's happening in America right now.
Well, I'm going to leave the South Africa one to you, because what I've learned about politicians everywhere is that I can't forecast them and I can't predict what they're going to do. All I can predict is that they usually disappoint me. So I think if we look at the States, we have to make peace with the fact that Donald Trump is going to keep us on our toes for the rest of his presidency. I don't see a time where he's going to want a nice, smooth, predictable lay of the land. I think he enjoys the volatility that he creates, and certainly if it's a tactic, he backs himself to deal with that volatility and the uncertainty better than everyone around him, and especially the people that he's negotiating with, if negotiating is the right word. So, I just want to give one context to one thing, and that's, we when we're talking about the times of volatile, we're in a situation where we get 3 days in a row where the American market goes down, and it ends up being kind of the steepest 3 or 4 day loss in the Standard & Poor's history. In other words, the S&P 500's history. And straight after that, because of a tweet or whatever you'd call that Truth Social post, where Trump says, maybe we'll back off on the tariffs for 90 days, we suddenly see the American stock market jump 9.5% in a single day. Now, that is one of the very best days in recorded history. So you in the space of less than a week, you've got a period of one of the worst downtrends in recorded history, and then suddenly one of the very best days in history. That kind of volatility is really astounding. And I think, if you're feeling unsettled as an investor, understand that this is we may not stay at these levels of uncertainty or volatility for the rest of Trump's term, but certainly that it's here to stay is a reality. And I think we can do something about that. We can't control the politicians. We can't do anything to protect our businesses or our investments when we don't know exactly what's going to happen. But what we can do is psychologically prepare ourselves for this. If it's a bit like running a marathon, don't start a marathon thinking that it's only 100 meters long. You're going to be very disappointed after the second 100 meters. But if you're in a marathon of uncertainty and noise and volatility, you can prepare yourself for that. And I think it helps you to take a much longer term focus if you say, okay, this is the norm. We're not going to get stability. I can't plan my investments or my business strategies around hoping that in 3 months' time everything's going to calm down. If you turn it on its head to say this is the norm, it's going to be crazy, it's going to be volatile, then you can start to make much better, more sensible decisions that are long-term and forward-looking, and don't worry too much about the day-to-day moves, because you just have to know, I think probably this time a week ago, we were looking at the rand, getting very close to 20 to the dollar, and now it's getting closer to 1850 to the rand. You just have to know we're in this now. This is our normal for a while.
Can you use market drops to make some purchases? And that's been one of the sort of features of the last few days, as you've seen companies like Capitec or ShopRite suddenly becoming more affordable.
I think you should do that. I would urge a little bit of caution. So, if we see a company drop in value alongside a bunch of other businesses, then that's a very good sign. That tells you that it might be a good buying time. But if a company drops in isolation and its peers don't, then just be very, very careful there. But I think where we are now, when the entire market falls and it has a radical fall, and you've got capital available, then certainly that would be a time to get a little bit more aggressive with the way that you invest. And just to understand that, I'm not saying go and take money out of your home loan and sell your car and invest that in the hopes that you're going to get another 9.5% day. I'm saying that you still have to have a long-term focus. But if you've got lazy capital that's lying around, that's been sitting in cash and doesn't have a purpose, then this is a good time to start buying in, and maybe just be careful of putting it all in at once. Don't be afraid of phasing it in, feeding it in over a month or three, because I think when markets are doing this, feeding the money in over a 3-month period, when there has been a big drop, it might just give you the opportunity to have 2 or 3 bites at the apple.
011 883 0702 021 446 0567. Your questions for Warren Ingram tonight on personal finance, and talking, of course, about how to manage your money in such a difficult time. So if unpredictability is now predictable, what does that then mean for us? I mean, how do we kind of survive that time, Warren?
Let's swing back to the South African political situation for a second. I mean, understanding that, lots of us, I think maybe some of the political parties themselves hadn't really considered a government of national unity that didn't include the DA, didn't include the EFF or the MK, and that was put on the table all of a sudden, and so just understanding that when you're in a state of flux like we are, we're relatively. I know the politicians want us to not say coalition, but that's really what it is, and when we are in a coalition environment, we need to make peace with that. Coalitions are very rarely stable and predictable. So understanding that when you're looking at the South African context, make peace with the fact that it's going to be unstable, and that there will be outcomes that you simply cannot predict. I wouldn't have said to you that there could be a government of national unity without MK, EFF, and the DA. It just wouldn't have occurred to me, frankly. And if that is a reality, I don't know what the outcome will be. I'm not convinced that's the world's worst outcome for South Africa right now. It creates further unpredictability, further instability, but maybe some of these unpredictable outcomes will end up working in our favor. And I do think that we need to know that if there is instability, it does create opportunities, because other people around you are not going to be comfortable with that unpredictability, and so they will often sell assets at ridiculously low prices simply because they want some certainty. They want to lock in some value somewhere, and very often we get to this stage of stock market or even property markets where we talk about capitulation. People just give up and believe nothing will ever get better again. And if you're comfortable that that things are unpredictable, and that you're happy to deal with that sort of unpredictable stage, then what it allows you to do is to buy assets when everyone else is selling in panic, and what you really then need to do is be comfortable to hold those assets for a period of time until we come out on the other side of this, and that could be in 3 months, 3 years, or 6 years, who knows? But if you're making peace with two things: one, that it's going to be noisy and loud, and social media will be shrill, and number two, that you shouldn't be hoping for stability and planning for stability. I think it gives you a real advantage to cope when others are simply not going to cope.
I mean, this is all about also just, being able to basically hold on. Markets, do they recover more quickly than you think they will? I think it's common to sort of think it's disaster, it's Armageddon when things go wrong. And a week later, it's almost like it didn't happen, well, certainly in this case.
and I think it's going to repeat itself like the proverbial broken record. I think we are in a situation where there is some hysteria. I think certainly if I look at the American media, they are. I think either they are hysterical or they're trying to create hysteria that to get more clicks, and in a situation like that. That sort of hysteria is unsettling, and understanding that if you make peace with the fact that it's going to be like that, and number two, that you can't sit on the sidelines waiting for everything to get better and waiting for things to recover. You don't know what that signal is. You don't know what the trigger will be for markets to decide that today is the day where we think we're over the worst and we're on our way to better days. It could be something entirely unpredicted. There could be a health event for an elderly president. It could be that suddenly the bond market reminds the American president that he's not the biggest force in the world. It's actually the bond market, and he has to learn humility. And if that happens and markets become convinced that he's learned discipline, that could be the time when we see a really quick recovery in markets. And there is no way that any investor will get that sort of a prediction right, Stephen. So I think people who sit on the sidelines and just wait for the world to get better, they're going to, I think, lose out on a very good recovery as and when it happens.
Your question for Warren Ingram this evening, the co-founder of Galileo Capital, on 011-883-0702 and 021-446-0567. Janet's been in touch with the question. She says, Warren, hi, I've read about the 4% rule in retirement planning. What is it, and does it apply to everyone? We'll have an answer for you in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, a certified financial planner at Galileo Capital. And Janet's question, Warren, was about the 4% rule in retirement planning. Does it apply to everyone? What is it? It's an interesting question from Janet. What is the 4% rule?
It's one of my very favorite things in the world of retirement, Stephen, because it is a rule of thumb. So like in all rules of thumb, it won't necessarily apply perfectly to everybody, but it's amazing how often it works. And the theory is that if you get to retirement and you've got your investment money and you say, I'm going to invest it in just a typical balanced portfolio. So if we look at the balanced unit trusts in South Africa, they're pretty much the vehicles that represent how retirement money is invested and has been invested for the last 30 years. And over that time, they've generated a return somewhere around 10 or 11% a year over 30, 40 years. And 30, 40 years is the duration of most people's retired lives. And so if you're going to get to the point when you retire and you've got this money invested, and you say, I'm just going to follow a very typical balanced unit trust, then the reality is you can draw 4% a year from that capital that you've got invested in those balanced unit trusts. And it doesn't matter if you own those unit trusts via your living annuity or just normal straightforward unit trusts. Either way, it doesn't matter. But drawing 4% a year from those investments means that you're leaving behind somewhere around 5 or 6% a year growth. And that tends to tie up with our cost of living. It tends to tie up with the inflation rate. So the 4% rule says that if you want to know whether you've got enough, take your retirement amount of investment assets, work out what 4% a year is, and then divide that by 12 just so that you get it to a monthly amount. And that's the amount of income that you can sustainably draw from your investments and still be sure that every year you'll be able to keep pace with the changes in cost of living. So it's a very nice rule of thumb for people that maybe are getting close to retirement, or people that are 10 or 15 years away and want to figure out, how much do I need to get there? Because just to help people with the maths, if you're saying, I know what my expenses are on a normal year, and it doesn't include kids' education and paying off the bond, because all of that will be done by the time I retire, you can take your annual expenses and multiply that by 25. It's exactly the same as using the 4% rule. So it allows people that are before retirement to work out how much capital they need, and people that are close to retirement, if you're drawing 4% a year, you're very sure that over the next 30 years, you'll have enough money, you'll be able to increase your income every year with the inflation rate, and still possibly leave some money behind if you manage to make it to the late 90s or even the early hundreds in age.
Okay, so that's quite a simple rule of thumb. I see what you mean. When we talk about, the main theme, of course, talking about the sort of unpredictability that we've seen, the uncertainty. There have been some stocks or markets that have fallen by 15%. You look at some share prices over the last little while, and it's very scary to look at that. How should you behave? How should you react when you see something like that?
I think that the headlines are scary, and I know the one that kind of attracted a lot of noise around the world was Apple, and talking about that, there was in a very short space of time, Apple lost something like $1 trillion in its total value because of the tariffs that Trump was going to impose. And $1 trillion is a heck of a lot of money. I just think it's not an amount that we can really contemplate, and that happened in a very short space of time. My suggestion when you see something like that is just take a moment to zoom out. Just go on the internet and work out, ask the question. There's so many good AI engines now that can help you with this, to say, what has Apple's share price done over the last 12 months? And you'll be surprised that, over a year, including all the big drops that we've just seen in the last little while, that Apple would have been up more than 12% over a year. So if someone's, screaming at you that it's lost 15% over the last few weeks, well, that sounds scary. That sounds like something you should really be paying attention to. But if someone says, hang on, actually, including that drop, it's still up 12%, then it gives you a bit more context. And I think making sensible long-term decisions requires context. It requires you to zoom out. What we need to know is Apple had a mighty run in its share price, through last year and right at the start of this year. So for it to have lost 15% in a 2-week period, it sounds dramatic, but actually, when you zoom out over 1 year and then over 2 or 3 years, you realize that Apple's done incredibly well for shareholders, even with that loss. And I think if you look at a stock market drop, when a share price drops for a very big company, that's a little bit traumatic for the shareholders and possibly for some of the staff who own shares. But at the same time, understand some fundamentals. Apple's sitting on more than R1 trillion of cash in its bank accounts. Sure. It can go for a very long time without selling much and still be okay. And in fact, those execs at Apple will probably use these kinds of drops to buy back some of their shares and execute rational behavior. So I think our job is to give ourselves context.